Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our weekly commentary on financial markets. Let's get started. So, this week, we're going to talk about something that has been, I imagine, upsetting equity investors for the last several weeks. Because for the last several weeks, equity investors have had to put up with something they haven't encountered much over the last year, and that is equity prices actually going down instead of up. Why have equity prices been going down instead of up? Well, because interest rates have been rising. And when interest rates rise, equity investors worry that that could be signaling the end of the big bull market in stocks. We're going to analyze why that is, and also why we believe that the testimony that we heard yesterday from Treasury Secretary Janet Yellen and from Fed Chairman Jerome Powell suggests to us that equity investors really don't have anything to worry about. All right, so what's the big fear when interest rates start rising? Right? The biggest fear is that interest rates could be rising, which is a signal that inflation is becoming a problem. And if inflation becomes a problem, then the Federal Reserve will have to stop printing money, which means no more big cash infusions into equity markets, driving asset prices higher. And once they stop printing money, the next step is to start raising interest rates. And once they start raising interest rates, a lot of times the equity party comes to a crashing halt. You might remember 2018. That is the last time the Federal Reserve raised interest rates. They didn't raise them a lot. They raised them from, close to zero over the course of 2016, 17, 18. They raised them to close to zero to about 2%. And by the time they finished raising interest rates in 2018, the equity market got very unhappy and fell more than 20%. So, are we sitting in a situation where the rise in interest rates is signaling that we could have an inflation problem, that the Federal Reserve may have to get involved? Well, first of all, recognize that there are two things that cause interest rates to go up. One is inflation fear. The other is an expectation that the economy is going to get stronger. So there is a premium that the bond market demands for inflation, and then there's what's called real interest rates. Real interest rates are very correlated with how strong the economy is growing. And we have a type of bond called TIPS, which is Treasury Inflation Protected Securities. As the name suggests, these are bonds that automatically offset inflation. So you don't have to worry about inflation at all. The interest rate on these bonds gives you a pure shot on what the bond investors think economic growth is going to look like. And guess what? Almost all the increase in interest rates we've seen over the last few weeks and months has been real interest rates. It's been interest rates on these TIPS rising, which means it's real economic expectations of real economic growth. It's not signaling yet any inflation concerns. All right. Well, that's what that's what bond investors are saying, but they don't actually determine whether or not interest rates rise. That's more the Federal Reserve. And that's where the testimony from Fed Chairman Powell and Treasury Secretary Yellen, who, remember, was Fed Chairman Powell's predecessor. So essentially, the Treasury Secretary used to run the Fed. The Fed Chairman, lots of respect for the Treasury Secretary. They share a lot of information and a lot of opinions. So when they testified yesterday, the bond market needs to really listen to what they were saying. And what they were saying was this. Fed Chairman Powell said, inflation is almost certain to rise this summer, and I am going to completely ignore it. You're like saying, well, how can the Fed chairman ignore inflation? Part of their job is to fight inflation. Well, he very carefully explained that after the pandemic lockdowns last spring, prices plummeted. And then as those lockdowns eased and the economy got a little better, prices came back up. Well, we're right now getting to the point where when you compare current prices to a year ago, you're getting close to the moment where you're going to be comparing current prices to the lows of the pandemic lockdown. That's going to make the price increases look really scary. But he's saying it's completely artificial, it's temporary. Just as those price collapse of last spring was temporary and they came right back, I believe this spike in inflation is temporary. I am going to completely ignore it, which means that short interest rate that the Fed controls is at zero. He's not going to take it to 2% like they did back in 2017, 2018. He's not going to change it at all. And the Fed feels very comfortable, and he committed to continuing to print about $120 billion a month. So that means more injections of cash into financial markets. All fantastic news. But wait a minute, could this change? Could there be, the economy's supposed to get a lot stronger this year. And with a 1.9 trillion stimulus package, could it be that, okay, so the Fed doesn't raise rates this summer, but maybe by the end of the year or early in 2022, do we need to worry about that? That's where Treasury Secretary Yellen's testimony was extremely important, because she was pressed on whether we needed a $1.9 trillion stimulus. She was pressed on whether there was a danger of the economy overheating. And what she said was, let's recognize that the current unemployment rate of around 6% is meaningless and vastly overstates the real health of the American economy. Because during the COVID pandemic, we lost about 9 million workers from the workforce. These are largely women who said someone's got to stay home with the kids, or they were in service industries that have not recovered at all from COVID. And rather than try and find a job in restaurants that haven't reopened, they are simply staying out of the workforce for now. She said, the unemployment rate isn't what I'm focused on. I'm focused on, have we attracted those 9 million Americans back into the workforce? Until we do, whatever the unemployment rate, sure, it's fallen to 6 and it may fall to 4, it may fall to 3, but I don't care. Until we get those 9 million people back into the workforce, the damage from COVID is still in our labor market, and I'm going to want to continue to be pedal to the metal, stimulating the economy, because we will not have inflation until the labor market is much, much stronger than it is right now. So take those two signals together. The Fed chairman is saying, yeah, we're going to have inflation increase. I don't care. I'm going to ignore it. I think it's going to be temporary. You've got the Treasury Secretary saying the economy is much weaker than the headline numbers would suggest, and we're not going to have any inflation problems until we have dramatically improved the conditions in the labor market. Both of these key economic policymakers are saying no interest rate increases for a very, very long time. And that means that while cash will stay at zero, as long rates rise, those long rates are simply reflecting the improving economic recovery. Those are real interest rates that are increasing, not inflation expectations. And one more concern that may be sitting in equity investors' minds is, well, what if rates rise too far? If we get rates of 2.5%, 3% on treasuries, that would be mortgage rates of 4, 4.5%, 5%. That could really hurt the economy. Well, I believe very strongly that the Federal Reserve cannot and will not let that happen. If the economy gets so strong that interest rates appear to be going up above 2%, 2.5%, getting to a level that could truly endanger our housing market recovery, truly endanger the ability of our federal government to finance the massive debt load that they've taken on to fight COVID and even before COVID. If interest rates get to that point, then I believe the Federal Reserve will crank up their printing presses to a higher level. They will buy more long-term debt, and they will drive those interest rates back down. Can they do this? Absolutely. All through World War II and right up to 1952, the Federal Reserve said, we don't let interest rates on 10-year treasuries go above 2%. Whenever it went above 2%, crank up the printing presses, buy, drive them back down. They were able to keep rates at that level for over a decade. If they want to do it, I think they still have the power to do it. And keeping interest rates at that kind of level, with the economy poised to accelerate to the extent that we believe it is, makes stocks the best game in town. Thanks for joining us for Market Insights. We hope you found it informative. If you did, could you like our video and share it with your friends? Also, if you'd like more of our research, you could subscribe at the link below, and you can check out our website, caravelconcepts.com. Thanks.